If you are struggling with VaR, CFaR, and ALM, you're not alone. These are the exact topics where most MBA finance students lose valuable exam marks. That's why I've selected the most important Unit 2 questions that are repeatedly asked in financial risk management exams. Watch till the end, download the free PDF, and make sure these marks don't slip away from you. Let's get started. Unit 2. Value at Risk and ALM1. What is VaR and CFaR? Differences and their role in investment decisions. VaR estimates maximum potential loss in portfolio value over a specific time at a given confidence level. CFaR measures maximum shortfall in future operating cash flows due to market risk factors. Differences. VaR is short-term for traders, while CFaR is long-term for corporates. VaR driven by asset prices, while CFaR driven by forex, commodity and interest rates. Role. Both support risk measurement, limit setting, capital allocation, liquidity planning, hedging decisions and performance evaluation. Before we move ahead, remember this. Examiners often ask students to differentiate VaR and CFaR, and many lose marks by writing only definitions. The next question is another favorite from past exams. 2. Discuss non-insurance methods of risk management. Non-insurance methods manage risk without involving an insurance company. Methods include risk avoidance by eliminating risky activities completely, loss prevention through safety training and equipment maintenance, loss reduction through sprinklers and backup systems, risk retention by bearing losses internally through reserves, diversification across products and markets, hedging using forwards, futures and options against price fluctuations, contractual transfer through outsourcing and indemnity clauses. These methods control exposure and maintain operational stability cost-effectively. Quick question: did you notice how hedging appeared here? That's because it connects with several financial risk management topics. Now let's move to a concept that banks and financial institutions cannot ignore. 3. What is ALM? Explain its evolution and concept. ALM is a strategic process of managing and coordinating assets and liabilities to minimize financial risks and maximize returns. Evolution went from asset-only focus in traditional banking to interest rate risk management in 1970s to 80s, duration and VaR techniques in 1990s, Basel norms making it mandatory, and modern integrated risk management today. Concept covers matching maturities, interest rate risk management, liquidity management, and profit planning to ensure financial stability. Here's an important exam insight. Students usually remember the definition of ALM but forget its evolution. That missing part can cost valuable marks. The next question focuses on where ALM is actually applied in the real world. 4. Discuss the significance and applicability of ALM system. ALM significance includes liquidity risk management, ensuring adequate funds to meet obligations, interest rate risk control using gap and duration analysis, profitability enhancement through optimized asset liability mix, regulatory compliance meeting RBIA and Basel guidelines, and strategic decision making for loan pricing and capital allocation. Applicability covers commercial banks, insurance companies, NBFCs, cooperative banks, pension funds, and corporate treasury for balance sheet risk management. And that completes Unit 2 clearly. Don't forget to subscribe, because the next unit contains several high-scoring concepts that are frequently repeated in university examinations. Let's continue your financial risk management journey.